Well, a new month means a new inflation report, and this time it's another sigh of relief for Americans. Inflation dropping to 6.5% last month. That is down from 7.1% in November. And this is the sixth month in a row that consumer prices have dropped in the United States. The Fed will be meeting at the end of the month to discuss raising interest rates yet again, but this new information could persuade the Fed to move less aggressively. Joining us now is Brian Coulton. He is the chief economist at Fitch Ratings. Brian, thank you so much for your time today.
Thank you.
So, Brian, this is the sixth straight month that inflation has eased, and every time there's an economic report, it seems like it continues to beat analyst expectations. Brian, what do you make of the state of the economy right now? Is the Fed's plan working?
Well, inflation is coming down, which is a good thing, coming down from its peak of 9.1% last June. But quite a lot of that is just explained by energy price is not rising so fast. And to some extent, the more kind of underlying measure, the guide to sort of where the sort of trend is in inflation, that's been a lot stickier. That's just below 6% in the latest number. It's 5.7, but that is not going down anywhere near as fast enough for the Fed to start to be comfortable that they've already raised rates enough. So I think they'll continue to raise rates, maybe not quite as rapidly as some of the more hawkish views out there, but I don't think this is enough for them to stop raising interest rates. Inflation is still too high at 6.5%, way above the inflation target.
I wanted to go ahead and parse out the report because I noticed that you were talking about how a big part of this was energy, meaning that gas prices, I think, were probably a big part of this. Housing also seemed to have ticked up a bit. What is your take right now in terms of the housing market?
Well, we're seeing house prices come down in the US, but what we're seeing and what matters for the CPI is rents. And rental inflation continues to rise pretty sharply. It rose to 7.5% year on year in the latest measure. Now, rents is a really big portion of the CPI basket, and it's accelerating. So that I think is a concern for the Fed. If you look at other measures of prices in the service sector, the services side of the economy as well, they're also growing pretty rapidly. So the services part of the CPI basket, this is nearly 60% of the overall basket, is growing at 7%, and rental inflation, it's not just high, it's actually increasing month on month quite rapidly. So that I think is a big concern for the Fed. The weakening in the housing market that we've seen in terms of house building and house prices, that's not being reflected at this point in the part of housing that goes into the CPI measure, the rental measure, and that's a big problem for the Fed.
And we have seen housing prices increase for quite some time now. But, Brian, I want to ask you, how much of the onus lies on the Fed to get this under control? Are there other ways to tackle inflation without raising interest rates?
Not really ones that you can rely on. I mean, at the end of the day, although the instruments of monetary policy are fairly blunt in terms of interest rates and the balance sheet, if you try and use other measures to control inflation, in the past, governments have tried direct price controls. They don't tend to work. Ultimately, those controls have to be lifted, and if the underlying demand, supply imbalance in the economy is not addressed, inflation will rise again as soon as those controls are eased. So, like it or not, I think tighter monetary policy is really the only route that you can sensibly expect the US authorities to take here. All these other measures don't really do the trick, and there's a danger of relying on those other measures, as I say, sort of subsidies or direct price controls. They just don't work. History tells us that.
So I want to ask you about the R word, because I feel like the R word has been bandied about now for the past 2 years, yet the job market is very strong. We are seeing unemployment at a historic low. We're even seeing consumer sentiment up right now. So is a recession still in the cards?
Look, we're clearly not in recession territory in the US at the moment. I think some of this debate about the recession last year was a little bit premature because we did have the headline GDP numbers were very volatile last year. We did a couple of quarters of negative growth in the first half of the year. But right now, the labour market is strong. Job growth is still over 200,000 a month. That's well above sort of medium term trend. So you say unemployment is very low. Consumer spending is still growing, but it's growing at a slower and slower pace each month. So we're definitely not in recession at the moment in the US, but I think the degree to which the Fed has already tightened monetary policy, the drag on real incomes from higher inflation, all of those things are cumulatively going to affect demand in the economy as we go into 2023. So we think by the middle of this year, consumer demand will start to fall and the job market will start to deteriorate. So we do expect a recession later this year, but we're not in recession yet.
All right. So obviously no one likes to see interest rate hikes, but the Fed is meeting on the 1st. And if you had to put your money on it, what would you say before I let you go, Brian? Would you say 50 basis points, 100 basis points?
I would say at this point probably 50. The market's been debating whether the Fed does another 2 or 3 rounds of interest rate increases, and then sort of signals that they've done that they're done. I think. Going to 5 or 5 1/4, ultimately another couple of hikes, 50, and then maybe another 25 after that. And I think they'll be pretty close to being done, given the outlook that we have for inflation and the economy.
I mean, I know that Powell's target here is what, 2%, 3% maybe. When do you think this all comes to an end?
Well, one area where we have a slightly different view to financial markets at the moment is that, yes, we see the Fed reaching a peak in rates of 5 to 5 1/4, somewhere around the sort of March, April time. But we don't see them starting to cut interest rates until 2024. If you look at the messaging the Fed's been given, particularly since August, it's the Jackson Hole meeting, they've been emphasizing the dangers of starting to loosen monetary policy when you've got an inflation challenge, starting to loosen monetary policy again too soon. And we think core inflation, underlying inflation, is going to be quite sticky. So even though headline inflation will probably fall quite a bit further by the end of this year, we think core inflation by the end of 2024 is still going to be around 4.5%, a lot higher than the inflation target. And I don't think, even if the economy is slowing, even if we're in recession, if core inflation is still over 4%, I don't think that would make the Fed comfortable with starting to ease monetary policy. But that's going to be a very difficult time for them if there is a recession, if people are losing their jobs, and if headline inflation has come down. The communication challenge the Fed's going to have at the end of the year is going to be a difficult one, but we don't think that they'll be ready to cut interest rates until 2024.
All right, something we are all watching extremely closely. Brian Coulton from Fitch Ratings. Brian, thank you so much for your time and for your expertise today. We appreciate it.
Thank you.
Coming up next, it's been 13 years, but the